Hi everyone, welcome back to the audit and attestation class. In this class of misstatement and internal control deficiency, we'll be covering in detail misstatement and internal control deficiency and indication of material weakness and the review engagement. Plus, we do some practice question. And this is part 2 of the misstatement and internal control deficiency. Please go through the part 1 as well before diving into this one.
Indication of material weakness. So what are the indicator of material weakness? First one is fraud, whether material or not on the part of management. If there is a fraud on the part of management, that may indicate you or that may give you an indication that there might be some material weakness possible. So they are just indicator, not the absolute conclusion, right? Just keep in mind these all are just an indication that may result into a material weakness, or that may you can say that may be the cause of material weakness in the overall financial statement. Second is restatement of previously issued financial statement to reflect correction of material misstatement due to fraud or error. So maybe in current year you have restated the overall financial statement of previous year, right? So now for an auditor, it is hard to correlate what was the number in previous year and what is the number in current year. So they need to do additional audit procedure for all those restatements. So that may be result into an indication that management might have some cooked up anything. C is material misstatement would not have been detected by the entity's internal control, or you can say weak internal control environment. If the overall environment or control environment is weak, like tone at the top is not good, there's no one like quarterly review the financial statement, there's no one at the management who is reviewing the MIS timely, there's no audit committee, there's no remuneration committee, there's no independent director, there's no director who is financially literate, right? So in that case of scenario, like oral control environment is not very stringent, and then may result into risk of material misstatement or material deficiency in internal control.
But the spelling of weak is incorrect.
Thank you. Thank you. D is ineffective oversight by those charged with governance of the entity's financial reporting and internal control. So oversight by those charged of governance means board of directors, shareholder, audit committee, they are not reviewing the financial statement on timely basis. They are not reviewing the internal controls on timely basis. That may give you an indication that there might be possible material weakness. Example of factor that may affect likelihood that the control or combination of control could fail to prevent or detect a misstatement. First one is nature of the financial statement, account, disclosure, and assertion. So for example, like sales is generally considered as more prone to the risk of fraud. So that's nature of the financial statement line item, because the management always try to inflate their sales to meet their financial performance targets, right? Second is susceptibility of the related assets or liability to loss or fraud. So there might be possibility that some financial statement line item are more susceptible to the related assets, liability, or loss or fraud, which is like, for example, cash in hand, or maybe you can say inventory, right? Inventory at third party location. Next is subjectivity or complexity involved and the extent of judgment need to determine the amount. So where more subjectivity or judgment or complexity involved, like for example, we were discussing earlier on accounting estimates, like estimates for litigation claim and assessment, right? Estimate for provision for doubtful debt, estimate for warranty, estimate for sales incentive, estimate for, you can say, percentage of completion method of revenue recognition, right? So there like complexity and subjectivity is being more involved. Those areas are more prone to the risk. Next is cause and frequency of the known and detected exceptions. So maybe in previous year or earlier year, you have seen the misstatement in that particular financial statement line item, and it is frequently occurring, right? So those also be an indicator. Next is interaction and relationship of the control with other controls. So whether the company do have mitigating controls or not. If they do not have mitigating control, then those respective control are high risk control, right? Last one is possible future consequence of the deficiency. What will be the impact of the deficiency on the overall financial statement? So these are certain example of the factor that may likelihood that the control or combination of control may be fails. Again, these are also again indicator for the control failures, possible control failure. So this is all what we have discussed is more related to the audit, which include like material misstatement and the control deficiency. Now let's jump into the review engagement. So how do you need to consider the impact of misstatement and control deficiency in the review engagement? So in the review engagement, which standard you follow for the review engagement?
SARS.
SARS, absolutely true. Right? Accumulate all identified misstatement and evaluate whether the individual and in aggregate material modification is necessary to the financial statement to be in accordance with the applicable financial reporting framework. So first thing is accumulate all the identified misstatement and see how much it's impacting the overall financial statement which you are reviewing as per the financial reporting framework. Second is the accountant should consider whether the result communicated by management indicate that the financial statement may be materially misstated or not. Third is if the accountant believes that the financial statement may be materially misstated, he or she should perform additional review procedure deemed necessary to obtain the limited assurance. Here you need to perform additional review procedure, right? Additional review procedure, not the audit procedure. What are the review procedure? Inquiries and what are the review procedure? Inquiries and
Examination.
Analytical
Procedure, sorry. Inquiry,
Yeah.
analytical procedure.
analytical.
Yes, gentlemen.
Okay.
Good morning.
Very good. Okay.
So what kind of assurance you provide in review?
Limited assurance.
Limited assurance, right? So it's clearly mentioned over here. You need to perform the additional review procedure deemed necessary to obtain limited assurance, right? For limited assurance. Make sense?
Yes, sir.
Yes, sir.
Evaluate whether sufficient and appropriate evidence obtained. If not, additional procedure judged by the accountant to necessary in the circumstances should be performed to form a conclusion on the statement. So in the review engagement, you will be accumulating all the misstatement you have identified and look at the impact on the overall financial statement rather than on the respective financial statement line item. And if needed, perform the additional review procedure. Review procedure include analytical procedure and inquiry procedure to obtain the limited assurance. In the review engagement, you'll be giving limited assurance. You are not required to do the inspection, examination, observation, confirmation. Those kind of procedures are not required for the review engagement. Right? Make sense?
Yes, sir.
Yes, sir.
Yes, sir.
Okay.
Yes, sir.
So we are done with two things. What are the two things we have done? Material misstatement and control weaknesses, right? So let's do some practice. In which manner should uncorrected misstatement be documented? How do you document in uncorrected misstatement? First one is separately consider the effect of known and likely misstatement, including uncorrected misstatement identified in prior period. Second is consider the qualitative factor that are relevant to the auditor consideration whether misstatement are material. Third is consider the aggregate effect of the misstatement on the financial statement. Fourth is all of the above. How do you document uncorrected misstatement? What's up?
Sir, all of the above.
All of the above? Why?
सर इसमें तो क्या ही है मतलब सारे ही होंगे इसलिए
Have
because
you
all
read
of those
some?
are required. Yes sir, ऊपर हमने वो पढ़ा था prior period misstatements वाला.
In this documentation section, you see
Yes
what
sir.
all things you need to document: materiality, uncorrected misstatement, separately consider the effect of known or likely misstatement, prior period misstatement, and aggregate effect of the misstatement. See all point number B.
Yes
Right?
sir.
Ayush, Gurmihar, Rahul.
Yes, sir.
Yes,
Yes
sir.
sir.
So this is exactly.
Where are you reading this question from?
Say that again.
Where are you reading this question from?
Where are we?
Where are you reading this question from? ये notes में नहीं है.
Oh, I might have added later on. Sorry.
Okay.
Yeah, but it's in notes. Yeah, which I sent yesterday. Maybe at that point of time missed to add the practice question for this topic, I think. Okay, sounds good, everyone? Why all the answer is correct? Because it's a mandatory documentation required for the uncorrected misstatement, which include effect of known and likely misstatement separately document, qualitative factor you need to document separately, and effect of misstatement, aggregate effect of misstatement you need to document properly. Right? So Nimisha, you'll be sending the screenshot.
I have already sent it. This was not छोटा है because वो template बहुत बड़ा होता है, so I had to zoom it out to take the pictures.
Maybe if you can send a blank template just for the
वो
benefit.
blank template ही दे. अच्छा मतलब you want the template itself?
Yeah, just maybe
Okay.
just for the benefit of everyone, just a blank template so that everyone can see. Okay, next question. In making a judgment about whether an internal control deficiency is so significant that it is a significant deficiency, which of the following should auditor consider? What is the call of the question? In making a judgment about whether internal control deficiency is so significant that is a significant deficiency, which of the following items should auditor consider? First one is diversity of the entity's business, size of the entity's operation. To evaluate and conclude that any deficiency is a significant deficiency, whether the auditor need to consider diversity of the entity business and size of the entity's operation or not, or one of them. What's your thought, guys? Yeah, Jaspreet, Pranjali, Sanchit, you guys are so silent today. Garvit.
So I was having bad throat.
I'm also not in a good throat. That's not an excuse. But what's your thought on this second question and why?
So I would say if both the options would be correct, because in order to check the scalability of the fact of deficiency which could happen in entire business, I would say that's wherein both the factors would come into picture.
What about you, Sanchit, Garvit, Pranjali, Vineet?
So we would need to check both because size of entities operation is important to check the at what level, what would be the material impact And diversity in entity businesses, like we are checking each segment basically. So that is also important,
Yeah.
because that we are not relying only on one process. We are doing an audit of complete all the other processes that are existing.
Yeah. Yeah. Ranjali, Vineet, you guys want to add anything? Misha.
No, sir, both.
Sir, both.
Both, but why? Okay, no, I think like Sanchit, you have explained very well. Both are important when you are evaluating the overall internal control deficiency, whether the deficiency is significant or not. You need to look at the overall size of the company and their operation, and then like diversity of the entity business if it is being having a different segment. So to which segment that control is impacting and how severely that control is impacting to that particular segment. Cool. So we are done with the first topic of the day. Now we are jumping on to the second topic, which is a written representation. So do you guys remember that like big table we have made in very first class for the things to be required in a written representation?
Yes, some management letter.
Yep. So here we'll be going through the written representation more in detail, but that summary is really very helpful for you for the examination purpose. So here we'll be discussing more in detail all those things, but crux of the story is lying in that summary, very well defined over there. So here we'll be going through the written representation required for audit engagement, review engagement, and attestation engagement, all three kind of engagement. So first we are going through audit engagement, which is management representation letter. Some firm says written representation letter, some firm says letter of representation. So like different firms use different terminologies. So nothing harm in using different terminologies, but overall it's a representation letter from the management in which management is confirming or giving their representation on certain facts, figures, and numbers, and the overall entity's operations and what they know and what they are already aware of. So they give the high level overview and representation to the auditor. So this management representation letter is actually a part of the audit evidence, but they are not the substitute of the application of those auditing procedures necessary to afford a reasonable basis of opinion. So mark this word. This is very important, or the most important statement for the representation letter. That means you will get the representation from management. For example, let's say you have, let's say management have certain litigations. They have litigations, they have claims, they have assessment, and they have done all the assessment and given you the representation that in this litigation, the company is going to win the case, and hence we are not taking any provision, or we are not disclosing in the financial statement. So management has given you this representation letter. Would that make you comfortable not to perform the audit procedure around the litigation claim and assessment? If the management is confirming you that there is no dispute, there is no litigation, there is no claims, or if there is any claim, litigation, or assessment, then chances are that management is going to win, and they are ready to give you in writing. So will it make you comfortable not to perform any audit procedure around that?
Yes, so if we are getting the representation letter from the management, we'll do our procedures and then get that representation letter confirming the same, and that should be okay. At least we will verify and check whether that is
So
true.
the call of the question here is that if management is giving you representation, would that make you relief from not performing audit procedure?
No, sir.
No.
No, sir.
Right? So the answer is no. You need to perform the audit procedure. That's your independent audit procedure and required as per the auditing standard. Right? Management representation letter is just a covering letter. That management is also acknowledging those things. Right? But it will not make you free to not to perform those respective audit procedure. Make sense? Huh? Rahul, Sanchit?
Yes, sir.
If management, so this is very important line here, it's not a substitute for application of audit procedure necessary to obtain the reasonable assurance. Right? If management representation is contradictory, for example, you have performed independent audit procedure against any, you can say litigation, and you come to the conclusion that litigation is going to against the company, as company have to end up bearing, let's say $100,000 or $200,000 or $1 million of loss. Whereas management opinion is that the litigation is going to be in their favor. So now you have contradictory view, right? Make sense? Yes, no?
Yes, sir.
Yes, sir.
If the management representation is contradictory to the audit evidence obtained, the auditor should investigate the circumstances and consider the reliability of the representation. In that case of scenario, you may appoint like other legal counsel to do the independent review of the litigation matter. And then basis on to legal counsel, you'll be concluding whether the management is saying right or management is not saying right. If your view is more affirmative to you or more convincing to you than the management, then it will be considered as a estimated misstatement, right? Likely and what are the two type of misstatement? One is
Likely and known.
And projected.
So this is projected or estimated misstatement, right? And then accordingly you will qualify if it is material to the financial statement. Management representation should be for all financial statement and for the period covered by the audit report. So when you are taking the representation letter, it should be covering the overall financial statement as well as it will be for the entire period of the audit, not only for the specific timeline or not only for the specific period. It should be for the entire audit period and for the entire financial statement, including all financial statement line item. So it should be cumbersome and overall. Specific representation should be made. So there are certain journal representation, which is very much standard format, but there are some specific representation that you need to take from the management. First is financial management. Management acknowledgement of the responsibility for preparation and fair presentation of financial statement in accordance with the applicable financial reporting framework. So you need to take the acknowledgement from the management that management has prepared, management has taken the responsibility to prepare to ensure the fair presentation of the financial statement in accordance with the financial reporting framework. Second is management believe that the financial statements are fairly presented in accordance with the applicable financial reporting framework. So two things. One is management responsibility for the preparation and ensuring the fair presentation in accordance with the reporting framework. So first one, the specific representation is about management responsibility. Second is completeness of the information. So here you need to take the confirmation from the management that make you available of all the financial records and data. Third is completeness and availability of all minutes of the shareholder, director and committee of the director. Third is communication from regulatory agency concerning non-compliance with or deficiency with the financial reporting practice. And lastly, absence of any unrecorded transactions. So here management is giving you confirmation that they have given you, and they have made available to you all the financial records, data, minutes of the meeting, communication with regulatory agency, and any unrecorded transaction. So this also you take in a written representation. Third is recognition, measurement, and disclosure. So here you take the confirmation from the management that management believe that the effect of any uncorrected financial statement misstatement aggregated by the auditor are immaterial to the financial statement taken as a whole. So if there is any uncorrected misstatement, here you are taking the confirmation from the management that those uncorrected misstatements are not material to the financial statement. There might be possibility exception of this, where you will write except 1, 2, 3, which is being reflected in the audit report. You can give the reference of the audit report, or you can give the reference to the respective notes to accounts or disclosure. Make sense? So far, so good.
Yes, sir.
What all things
Yes,
you
sir.
need in the
Yes,
management
sir.
representation letter?
Yes, sir.
Third is knowledge of fraud or suspected fraud. What is suspected fraud? Any idea what is suspected fraud? Yeah. Any rough idea, any thought? What is suspected fraud?
The item that we would have identified and we haven't collected much evidence about it till now.
Anyone else? Yeah.
Fraud which we are suspecting, like the fraud which we think it is, but we need to check and verify. We do not have a conclusive proof that it's a fraud.
Like we just heard it from the people of the company, maybe employees and all.
Which is not
We have
yet
not-
proved.
Yeah.
Sorry, say that again.
Possibly
Which
a
is
rumor.
not yet proved.
Sorry, I didn't understand.
It's possibly a rumor. I mean, see, we heard it from the employees of the company, and we have not yet, confirmed or did some analysis on the same, whether it's actually a fraud or not.
Rumors. Okay. What else?
Which is not yet proved. Exactly.
Which is
Which is not yet proved.
not yet proved. Yeah. Yeah. And what is knowledge of fraud? Where like the fraud exists or fraud has happened. Some employee has taken, you can say, asset, misappropriation of asset, or embezzlement of funds, right? Suspected fraud, where you are not confident, but you are suspicious that there might be a risk of fraud, right? So those things you need to acknowledge and communicate to the auditor of the areas where you suspect the fraud, or maybe like segment in which you suspect the fraud, or maybe the employee where you suspect the fraud. So those things you need to communicate to the auditor, or you need to acknowledge to the auditor, right? D point is knowledge of allegation of fraud or suspected fraud affect the entity received in communication from employee, former employee, analyst, regulator, short seller, or others. So first thing is where management see any fraud, right? Maybe by vendor, maybe by customer, maybe by employee, maybe in any segment, maybe any, you can say third party, right? D point is where other has made allegation on the company about the fraud. So that may be by their employee, by their customer, right? Former employee, analyst, regulator, right? So those things also they need to acknowledge and give into the representation letter to the auditor. E point is plan or intended that may affect the carrying value or classification of assets and liability. So if the management have any plan to sell off certain asset in future, right? Those all things you need to communicate upfront, because that may have impact on the financial statement. So because the assets which is you have put on sale need to be recognized or need to be calculated or need to be valued at the net realized value, not at the book value, right? F point is related party transactions and related parties. G is guarantees under which the entity is contingently liable. What is guarantees? Any idea? Have you heard about
So the product guarantee?
product guarantee, bank guarantees, third party guarantee? Have you heard about these terms?
So Like in guarantee, what we do is we generally give guarantee on behalf of another to another party for, to a bank, like in case he fails or defaults in payment of repayment of loan, then we will be liable for that payment, and that is contingently liable because it will only arise if that party is not able to make the payment on whose behalf we are giving the guarantee.
Yeah, and then so the guarantor need to disclose as a contingent liability in their financial statement. So that's the reason it is being required representation from the management. Significant estimates taken by the management. So especially for the accounting estimate which are significant. So all those estimates need to be disclosed and represent over here. Violation or possible violation of any law or regulation, unasserted claims or assessment, other liability and gains or loss on contingency that require to be accrued or disclosed, satisfactory title of assets or on lien or encumbrance, right? Compliance with aspect of any contractual agreement or debt covenant or any subsequent event. So these are mandatory things for which you need to take a representation from the management. Fourth point is management representation letter should be addressed to whom? Management representation letter should be addressed to whom?
To the auditor.
To the auditor, right? They are giving representation to the auditor and should be dated of the audit report, not the balance sheet date. It should be dated audit report on the date of signing. That means they are covering all subsequent events as well, right? Reissue prior period financial statement and audit of the predecessor auditor. In case if there is any reissuance of financial statement or audit report required for the prior period audit, then in that case also to the predecessor auditor should obtain an update representation letter from the management. For example, previous year financial statement have been audited and signed by, let's say, Jasprit and Ayush CPA firm. Now in current year, let's say Garvit and Sanchit CPA firm has been appointed and they have identified certain misstatement in the prior year financial statement. And they requested management to revise the prior year financial statement, and management in turn requested Ayush and Rahul to update their audit report in the previous year financial statement. So in that case of scenario, Ayush and Rahul would be requesting management to give them updated representation letter on the previous year financial statement for which they are changing their opinion. Make sense? Yes, no?
Yes, sir.
Yes, sir.
So note over
generally,
here.
is this possible? Like once the report has been published, because prior year numbers would have already been published.
But if you have noticed any material or significant material issue in the prior year, then you can revise.
Okay.
Right. We'll be discussing that in this chapter only. Yeah. So today only we'll be covering that also. So fifth point, if you see, fifth A point, if you see whether any information come to the management attention that would cause them to believe that any previous representation should be modified, and whether any event have occurred subsequent to the balance sheet date of the latest financial statement that would require adjustment or disclosure in those financial statements that need to be disclosed to the predecessor auditor. If management refused to furnish the representation letter. So this is also important. You will see a lot of question around this. If management refused to provide the written representation letter, then it's a gas issue. That is a scope limitation. You'll be qualifying if it is like material to one or two financial statement line item, or you may be disclaiming the opinion if it has a pervasive impact, or you withdraw from the engagement. Most of the time, if management disagree or refuses to provide representation letter, then it's better to withdraw from the engagement because it have pervasive impact, right? If the auditor is precluded from performing the procedure. So for example, if auditor has been asked not to perform this procedure or that procedure, so that also comes under the scope limitation. Right, and it have material impact on one or two financial statement line item, then you'll be qualifying the opinion. If it have pervasive impact, then you'll be disclaiming the opinion, or you can choose to withdraw from the engagement. So these are specific representation in addition to the metrics which we have discussed in the beginning, where we have all things need to be considered in a written representation letter. So these are specific thing which is mandatory required into the written representation letter. So we have discussed on the audit engagement. Now coming to the review engagement. Are you guys with me?
Yes, sir.
Yes, sure.
Yes, sir.
Yes, sir.
So we are done with audit engagement. Now we are jumping into
Review engagement.
review engagement, then attestation engagement, and then we do some practice, and then we'll take break before starting the next chapter. Right? Only 3 pages, not much. Don't worry. 2.5. Review engagement. So what is review engagement? What do you do in review engagement? What procedure you perform for the review engagement?
Inquiry and analytical procedure.
Inquiries
And
and
provide limited assurance.
Limited
Analytical
assurance.
procedure.
And give limited assurance.
inquiries and analytical procedure,
Analytical
and you
procedure.
provide limited assurance, right? Keep these 3 things as a key pointers in mind, then it will be easy for you to digest why the representation in the review engagement is so less compared to audit engagement. First one should cover all financial statement and the period covered in the review report. Same. Second is obtain specific written representation on following. First is management responsibility. What are the management responsibility? Preparation and fair presentation of financial
Financial statement.
Financial statement.
financial statement is the responsibility of the management. What is the second? Design, implementation and maintenance
DIM.
of
DIM.
internal control, Mr. DIM. Right? Management full and truthful response to all the inquiries. So here you will be taking a representation that management has given a full and truthful response to all the inquiries made by the CPA, right? Next is all the transactions have been recorded and reflected in the financial statement, and management has disclosed its knowledge of any fraud, suspected fraud, all known instances of actual and suspected non-compliance with law and regulation, and all related party transaction and related parties. Management has disclosed that it believes the effect of uncorrected misstatement are immaterial. So here it means to say all material misstatement has been either corrected. If it is not corrected, then you will be giving an exception to this line. Management has disclosed that it believes the effect of uncorrected misstatement are immaterial except 1 or 2, right? F point is
But sir,
management.
materiality is conducted by the CPA, na?
Yes, absolutely. Absolutely.
So then how can we rely on them that it is immaterial? Because we don't
No.
convey that what is the material amount.
No, we will be communicating that these are the material misstatement, whether you correct it or not. So if they are not correcting it, then those are material misstatement.
So like sir, like we discussed an example of we gave 5 to 6 transactions that they need to adjust, and out of those they agree to out of 5 they agree to do only the 2 adjustments.
Yeah.
Rest 3 we would need to check that if it is under tolerable error or not, so that we can issue a statement accordingly.
Yes, absolutely.
But then if they will, how will we convey that? Because if management is saying that they will give us the letter of incorrected misstatements.
So we'll be communicating like these are the uncorrected misstatement.
Okay.
We'll be communicating them, we'll be discussing with them, we'll be understanding the reason why they are not correcting.
Okay.
Right?
So
That's
we
all
will be first having a meeting and getting to agreement that okay, these transactions are done, and then only they will issue a letter in management.
Yes.
Okay.
Right. F point is management has disclosed all known actual or possible litigation claims and assessment whose effect should be considered when preparing the financial statement. Management has disclosed that it believes all significant assumptions used by it in making the accounting estimates are reasonable. Management has disclosed all information relevant to the going concern assumption in financial statement. Management has properly accounted for or event occurring subsequent to the date of financial statement. Right? So these all are representation we'll be taking from the management for review engagement. Right? Make sense?
Yes, sir.
So this you can consider in audit as well. Management has disclosed all information relevant to the use of going concern. So this will go in audit as well. Cool. Okay, 1 second. So now coming to the notes. If management does not provide written representation or accountant have doubt to the management integrity that representation provide are not reliable. So in that case of scenario, you'll be discussing the matter with those charged with governance. If you're still in doubt, then withdraw from engagement. And representation should be made as on the date of review report, and representation should be signed by those members of management whom accountant believe are responsible for and knowledgeable of the matter covered in the representation letter. So these things you need to keep in mind for the representation. Now coming to the attestation engagement. Attestation engagement, what are the attestation engagement? There are 3 types of attestation engagement, right? Do you remember?
Review, examination, and agreed upon procedure.
Absolutely true. Agreed upon procedure, review engagement, and examination engagement. So first we'll be covering examination and review engagement, then we'll be coming to agreed upon procedure. So first line, if you see examination and review engagement, accountant must obtain written representation of acknowledgement of other evidence of the responsible party responsibility. For agreed upon procedure, written representation is not required unless related to compliance attestation engagement. However, if accountant feel representation is useful and practical, then he can ask for the same. But for AUP, it's not mandatory. What are the matters to be covered in the examination and review engagement representation letter? First is a statement that the subject matter is based on or in conformity with the applicable criteria, that all relevant matter are reflected in the measurement and evaluation of the subject matter or assertion. Second is all known matter contradicting the subject matter or assertion and any communication from the regulatory agency affecting the subject matter or assertion have been disclosed to the accountant. Third is acknowledging the responsibility of the subject matter, selecting criteria if applicable, and determining that such criteria are appropriate for the purpose. Lastly, a statement that fourth one is a statement that all record and information relevant to the subject matter have been disclosed to the accountant. Once again, fifth is disclose all material subsequent transaction, disclose all relevant significant deficiency in internal control, which is knowledge of actual or suspected or alleged fraud or relevant non-compliance with law and regulation or other appropriate matter. Seventh is uncorrected misstatements are immaterial. If there is material, then accept to that. Last one is significant assumption used in making the material estimate are reasonable if applicable. Note 1. If representation representation should be obtained from the responsible party or client and should be dated as of the attest date. Second is refuse to provide written representation. In case of examination engagement, you can qualify, disclaim, or withdraw, depend on the accountant assessment. For review engagement, it is scope limitation, so you can withdraw from the engagement. For agreed upon procedure, it's not mandatory, so you can disclose the inability to obtain the representation in report, or you can withdraw, or you can change in any other form of engagement. So that's completely your choice. Right. So this is all about representation letter for the audit engagement, review engagement, and attestation engagement. Any doubt here? Yeah, Rahul, Kush, Ayush.
Can you move to the last line that we just discussed? In this, when we are saying that we are doing agreed upon procedure, in this it is not mandatory to maintain the representation letter, right?
Yes.
So why will we withdraw then? Like, why is that option even
it's an auditor's choice, basically. So if you feel, it's your professional judgment. If you feel that you should take a representation letter on any particular subject matter, but management is not agree to give you that representation, then you can withdraw.
like my view was management would also know that this is an agreed upon procedure. They're like they can also.
So there are different type of agreed upon procedure also, depend on the risk.
Okay. Okay.
But then, sir, will it be safe to say that most of the times the auditor would like to obtain some sort of management representation so that they are more comfortable with what they have?
Yes, because that give an acknowledgement from the management side also.
Yeah.
It's not only auditor's opinion, it's more of acknowledgement of what auditor is communicating from the management side as well. Okay, let's do 2 questions and then we can take a break. First one, an auditor most likely would require management to highlight which statement in a written representation letter to obtain for an audit. So in audit engagement, what representation CPA take? First one is management acknowledgement. It's responsibility of design and implementation of program and controls to detect the fraud. Second is management believe the financial statements are accurately stated in accordance with the generally accepted account auditing standard. Third is management plan to expand into international operation during the next few years. Management believe that the company is premier company in the industry regarding the services to the customer. Which one most likely? Why?
Option 1, because option 2, it says gas. Ideally, we will prepare the financial statements using GAAP, so it won't be applicable. I mean, that's incorrect statement, ideally. Then the third one is talking about expansion of international operations. During the next few years, it is not required to be captured as part of management letter. And then the last piece, it's premier company in its industry. Again, that's basic company information. I don't think it's not relevant to for the management letter. So it's only the first one.
Makes sense. Last question before we go for a break. To whom should management address the written representation about the firm's annual audit?
We just
Board
read
of
about it,
directors, shareholder, auditors?
Yes.
You all are auditors. You want something to address, huh? Okay, so far we are done with 2 major topics. So we have just one more topic and then we have certain annexure which we'll be discussing after the lunch break.